Here is a question to test how good you are at technical analysis. Have a look at this price chart that has a 200 period moving average. Do you know why the price reversed right here and failed to trade higher? What makes the level there so strong that price was unable to break through it? Was there something hidden from your eyes? Well, you might say there is an area of market structure acting as resistance as you look to the left. But while that is perfectly correct, there's also something else that you might have missed out. And that is the 200 hot moving average. After inputting in the hot moving average, can you now see why the price reversed at that level? Perhaps you are already using simple and exponential moving averages. But in today's video, I want to show you the other types of moving averages that you should insert into your charts. Before I go on, I would appreciate it if you would take 3 seconds of your time to like this video and subscribe to this YouTube channel. There are a ton of Forex videos on our channel which are designed to help you become a better trader. I also have a free day trading guide which you can download via the link in the description below. So the moving average is one of the most commonly used indicators because it effectively tells you the trend at a glance. It is used to calculate the average price of an instrument over a set period and is widely used by many trend following traders. Let me break down the main types of moving averages used by traders. For you to contrast the differences between the moving averages, I've plotted the various types of moving averages on the same chart with a 20 period setting. The simple moving average is the most common moving average and represents an average of the closing price over a period. It is more stable and less reactive to recent price changes. The next moving average is the exponential moving average, which gives a higher weight to the recent price. A shorter period selected means that more weight will be applied to the recent price. Certainly, the calculation of an exponential moving average is not as simple as a simple average as in the case of a simple moving average. When it comes to the exponential moving average, it is important to remember that it's more sensitive to the recent price action, contrary to the simple moving average. The next type of moving average that most traders are unaware of is the triple exponential moving average. It seeks to reduce the lag of the typical exponential moving average. Because it triples the weight of the recent prices, it responds to price movement much quicker than the simple or exponential moving average. Then we have the adaptive moving average, which was created as an enhancement to the original exponential moving average. It multiplies the weighting of the exponential moving average with a volatility factor. And because more weight is applied to the recent price movement, it adapts quickly to the market whenever volatility conditions change. It is more effective than other moving averages because it filters the noise in the trend while considering the market volatility. Next, we have the Hall moving average, which was introduced at the beginning of this video. It is a fast moving average that is responsive but with reduced lag. Developed by Alan Hall, it uses several weighted averages in its calculation, and Hall claims that his formula reduces market lag while increasing the smoothness of the indicator at the same time. Another type of moving average that is rather similar to the hot moving average is the weighted moving average. It was designed to find trends faster while filtering out false signals. The weighted moving average places more emphasis on the recent price movements and thus reacts more quickly than the simple moving average or exponential moving average. Last but not least, there is the Zurich moving average, an indicator used by some institutional traders which most retail traders are not aware of. It is a powerful indicator that smoothens the price data with a very small lag. Now, With this comprehensive list of moving averages, you might be wondering which type you should be using. Well, traders use different types of moving averages for different reasons. Some are interested in the long-term direction and trend of the market, while others might want to trade off intraday trends. Bearing this in mind, the length input into a moving average should depend on the objective of the trader. Naturally, shorter moving averages should be used for short-term trading, while longer moving averages should be used for swing trading or position trading. To help you better understand how to incorporate this into your trading strategy, I've broken down the moving averages into 3 distinct categories. First is the long-term moving average, such as the 200 period moving average or the 365 period moving average. Between the two, the 200 period moving average is the most commonly used moving average, as many traders use it as a form of reference. It is believed that big institutions like banks and hedge funds are watching this indicator closely. Then we have the medium-term moving averages, such as the 50-period moving average and the 100-period moving average. Between the two, many traders prefer to use the 50-period moving average since it isn't too short or long and thus react more to medium-term movements. It is one of the most effective trend-following indicators and can also be used as dynamic support and resistance. The last category of moving average is the short-term moving averages. Examples of this include the 10-period moving average and the 20-period moving average. Such moving averages are good for traders that want to trade with the short-term momentum in price, since they react the fastest to price. An important pointer to remember when applying moving averages is that they are lagging indicators that rely on past information. Thus, it is not a crystal ball that helps you predict the future. A higher period moving average will have a much greater lag compared to a lower period moving average. A lower period moving average reacts quickly to price changes and offers more signals. However, these signals tend to be less accurate. Therefore, a trader needs to find a balance between using a high and low period setting. Again, I will reiterate that you should choose a moving average depending on your trading style. Hopefully you found value from this video. As always, if you benefited from this video, please make sure to subscribe to this channel. Click the notification icon so you won't miss any of our new videos. Do leave us a like to support this channel. Thanks for watching and make sure you download the free day trading guide via the link in the description below.